Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor or you're interested in being a multifamily investor, maybe you work in the multifamily industry every single day. Well, this is the YouTube show, and it's also a podcast that we designed especially for you, breaking down all of the latest research reports, market surveys, data points, original opinions, and articles revolving the multifamily industry, real estate, and the general U.S. economy, brought to you every single week, not only in the Gray Report, but also the Gray Report newsletter. Matt Bosnagel, Director of Communications and Marketing at Gray Capital, is joining us. We're going to break it down. Some really interesting articles from the National Association of Realtors, Marcus and Millichap, RealPage, Florida Atlantic University, and Fortune. Let's get into it. All right, welcome back to the Gray Report. Matt, interesting week. Some good reports out.
Yeah.
I'm sorry we can't be face-to-face, in person, in studio, but how are things going over at Gray Capital HQ?
They're going pretty well. I think we're plugging away, and we've got a lot of good work we're doing, and I think we're working pretty hard this week.
A lot of stuff going on. We got acquisitions pending. I know we're doing due diligence walks down in Bloomington today. We were doing due diligence walks last week out in Terre Haute. So a lot of exciting things.
Team is growing.
That's true. Keeps getting bigger and bigger every week, it seems like. So that is really cool to see. If you're interested in our progress, follow Gray Capital on LinkedIn. All the social media channels will keep you up to speed. And if you're not subscribed to the Gray Report newsletter, comes out every Thursday, 8:30 in the morning, Eastern Standard Time. If you like the reports and are interested in, understanding what's going on in the multifamily market, you're going to want to make sure you're subscribed to the Gray Report newsletter. It packs full. What would you say, Matt? 15 to 20 reports and articles every single week?
Yeah, at least 20. I got to get 20. Last week was 27, but
too much, too many.
It was bursting.
Maybe it's too much, but so much of this, it covers just different facets of, again, not only multifamily, but just real estate, other commercial real estate. We keep hearing what I always find really interesting, Matt, and it makes me feel like we're doing something right. Investors say they like it, but it's like the brokers, it's like the lenders, it's like the people that are in the industry every single day. They look to the Gray Report to get this type of information, and it's very humbling for when I have someone that comes up to me that I respect, that's been in the industry for decades, saying, "I love your newsletter." I read it every single week. I'm like, awesome. So kudos to you and the rest of the team.
I think we all work really hard on it. So it's really nice to hear, for sure.
That is true. Well, Matt, let's just pop into this because the National Association of Realtors, they've got a commercial market insights report for October 2022. It's giving us a snapshot of handful of different commercial real estate asset classes, multifamily certainly to be included in that. It had some interesting takeaways. Summary, not too surprising that multifamily and industrial continue to lead the way in terms of demand and performance. Although, they bring it up as well. It's brought up in detail on the RealPage report that we're going to be getting into as well. Multifamily absorption is down without a doubt. Multifamily absorption in the third quarter was negative, and we will most likely see a negative absorption for Q4 as well, as that is seasonally, historically something that happens because it's a slow season. Typically Q3, it's still in the busy season. It's just before people are going back to school. There's a little bit of lag over, usually still strong demand, but it seems like there's been a major slowdown, and it's not that necessarily it's really people don't want to move. It's the same thing with single family home sales. And I would say for many decisions, major financial decisions that people are thinking about, whether that's making an investment, buying a house, uncertain times breed inaction. And that type of inaction is leading to less people moving to find a new apartment, especially when we've seen rent increases that have been substantial, and that renewal on your apartment's typically going to be less, plus moving costs that you have to factor in if you're going to go somewhere new. So more and more people are saying, I'm going to stay put for the time being. While at the same time, apartment owners are seeing this. They're seeing, okay, I'm not getting as much traffic in. It's a traffic issue. I'm not getting as many prospects.
Yeah.
I need to maintain occupancy going into the winter months because nobody's leasing apartments in the winter. You're starting to see rent specials. You're starting to see discounts. You're even seeing rent being dropped because it's like, well, we've increased the rent $250 over the last year. Let's drop rent $50 to $75. We're still beating our pro forma. It still looks good. But what we don't want to have happen is have a major loss in occupancy, which could be the case if you don't keep up with leasing.
Yeah, interesting. And it's very weird how much similar this economic uncertainty is to kind of the beginning of the pandemic. People were staying home and clutching during the beginning of the pandemic.
Yeah.
But then demand went up a lot significantly. And I don't think that's happening right now. And it's interesting to think about how much moving really drives a lot of this demand. And if you're staying put, you're not going to generate that's just like commerce 101, I guess. But the fact that we didn't see any traffic, and I've heard this a lot, where they were seeing the lower traffic in the summer months and they were thinking, okay, this is not going to bear fruit is what, and rents are going to go down. And so,
well, in the, I guess the thesis is that demand was carried forward or stolen in 2021. We just grabbed the demand from 2022, and a bunch of people moved around, made decisions, and there's a lot of velocity of just all kinds of things happening in 2022. Things were good, stock market was up, and now it's just the opposite. And people are like, inflation's high, rents are high, interest rates on new home are high. I'm just going to wait this one out and see what happens over the next 6 months or so. The big question that, Matt, you were just alluding to is the same thing that happened during the pandemic in 2020 when everyone froze. After that, there was a little bit of a frenzy. Is there going to be some pent up demand that's going to happen in 2023? I think it's yet to be seen. It also, another factor that I think we need to discuss, which is it's hard to put a finger on, but if we're in a recession or not, and is that just the macro environment going to cause some declines in rent, negative absorption that we're already seeing. And if you get through that, typically there is a big increase in rents following a recession, typically a year or two after a recession. But are we going to get to that? How does inflation play into that? Because there's already been a lot of rent growth. So there's a lot of unknowns. And I think just by sticking to your principles and sticking to your guns, you're going to make some good decisions. But I don't think it's a time to sit on your hands and not do anything. But it's time to certainly be cautious and think twice to make sure we're all doing the right thing. Because here's the tough thing. On one hand, we're in a technical recession with some 2 consecutive quarters of negative GDP growth, but job market continues to be very strong. According to the NAR report, unemployment is still incredibly low. I mean, there are about 1.7 more jobs in August 2022 than March of 2020. So we've gained all the job losses back. Incomes for apartment renters for new leases signed is actually up 13% year over year. So people are making more money. People have jobs. But inflation is high, and we've had negative GDP growth, and the stock market is down. The yield curve is inverted, so it's just this weird confluence of factors that leaves a lot of folks scratching, because we are in an environment where we've just never been in before. No one has, and charting out the course is difficult. But I also think Howard Marks says this quite a bit. Is that people always say that this time is going to be different, and is it really? And I think there's still some analogs into history, maybe not exact analogs, but I think there's going to be a lot of this. I think is just relatively simple mean reversion and normalization that we all expected. It just doesn't feel great. because we want things to keep going up, but that's just not like the reality of how things usually work.
Not that steep.
No.
Over the past week, I've seen all these charts that show a big, maybe if you scope it out, we're going, rents are going at a slight slope. That's sustainable. But clearly the jump up in 2021 was too steep, and then we're going to see a little bit of a jump down, but it's not going to go all the way down. If historical trends are true, and that's what Howard Marks was talking about is really like, let's look at the historical trends, and it would be extremely unusual to see anything like that, because also looking at all these line graphs, it is like the steep thing, the steep peak of a line graph is almost always followed by a little bit of a dip too.
Exactly. And then, but what multifamily is going for it is just the incredible supply and demand imbalance that is theoretically going to act like a floor for any type of loss, just because there's only so many apartments and people want to live in them. Sorry, go ahead, Matt.
To put things in kind of context, there's been a lot of talk of record amount of supply coming online, and I think there probably are a record amount of projects that are ongoing. But the dominant news story in the most recent NMHC construction survey, which can be found in the Gray Report newsletter, it says that we're slowing down. We're still seeing delays. They're still seeing permitting delays too, and it's not it's not like things are clearing up and unclogging. And it's interesting to see that, like, even though labor wages supposedly are going down, the time it takes to complete a project is still fairly long. But I also wanted to note this in the multifamily section specifically. It is something that we've covered before. I think we were talking about Jay Parsons' comments on the consumer price index measures of rent growth. And it does have some comments here that I thought were really insightful as well.
What are those comments, Matt?
All right. I was giving you a breather if you wanted to jump in.
Oh, well, I will, but I want to know what the comments are.
It says the consumer price index, which does provide information about rent inflation, uses data from the consumer expenditure survey to determine the level of prices. While this is a survey, most renters report the rent they had locked in earlier. This means that rent changes may take months to be reflected in government data. In contrast, the private sector publishes the listed rents, which are the current rent prices. Thus, government data will likely show a decelerating trend in rent prices after several months. And this is the bolded point that they noted in the report. No matter the source, rent growth will remain strong as many buyers are forced out of the market. They say due to fast rising mortgage rates, buyers need to earn more than $100,000 to afford to buy the median price homes.
Wow, that's very certain. That's like very like declarative.
Yeah, it's very declarative. This is
no matter the source. Don't just it's rent growth is strong. Will
remain strong. Well, I do think that that rent growth will remain stable and I think fairly strong. But we have discussed the potential correlation between mortgage rates and rent growth, and it is a little bit weaker than would be assumed. It's maybe on the margins, yes, but what you were talking.
I don't think we've seen in like the bump to multifamily like yet.
That would be a really good. I'd love to see a survey, or not survey, a study that eliminates all the variables and really looks at, okay, as mortgage rates went up, how much was rent impacted? Because it's the housing market. If it makes the housing market more expensive, then if rising mortgage rates make the housing market, puts pressure on that. That's going to put pressure on renters as well.
But like magic. What Jay Parsons, which we're going to feature a piece from Real Page and Jay Parsons here in a minute, but some things that he said that we've, I think we would agree with, is that, and it's counterintuitive, but housing demand is housing demand. For sale, for rent. They're very rarely is it completely decoupled. It may be decoupled on the margins, but it's like people are looking to move out because it's more linked to household formation than anything. It's like when people are moving out of the room, living with a roommate. Hey, I'm going to
Yeah.
go live on my own or whatever. That's what drives the growth, not just, oh, single family home. That's not, that's all in the margins.
That's good. That's the connection, because
Yeah.
I was just about to talk to mention what you were talking about earlier, which is, we're in this environment where there is general economic uncertainty, and that might be the primary mover of whatever happens in the housing market or multifamily specifically. Is what's the economy doing? If it's a general recession, then you could probably count on weaker performance of multifamily. But if the economy does have maybe a softer landing than is expected, then we'll see stronger things. Now, I do want to note that of all of among this economy, among this like uncertainty, there were reports that came out this week. There were several that really emphasize how commercial real estate is a lot better of a place to put your investment than maybe the stock market. So it is somewhat of a sanctuary, but it is it's definitely correlated with the performance of the general economy.
Yeah, no, 100%. Yeah, it's much less correlated to public markets and other assets, stock market. But to say that there's no relation to, the general economy and multifamily that's just silly. And specifically when the biggest buyer of the mortgage-backed securities, these securitized loans that are used to finance not only single-family homes but multifamily properties, the biggest buyer of those bonds has been the Federal Reserve, and they've left the market.
Yeah.
They've increased the cost of capital to purchase these assets in the form of increasing the Fed funds rate, bumps up the short-term loans, and we've seen the 10-year rise and fall and rise and fall and rise again. So those all have clear impacts over the environment. And again, even if it's just the psychology of investor sentiment of not being able to make heads or tails of what to do right now. And we're seeing a little bit of market freezing over. It's not completely frozen. Deals are still getting done. We sold a property last week, closed just fine. We're buying some properties, but we're like, it's, one step at a time. We're like moving slowly and like, all right, what are we missing anything? What happens in a worst case scenario? Or are we going to be still in a good spot? And I think having the ability to look 5 years plus out, I think is necessary, because to say that the values of any asset is going to be higher 6 months from now, I don't think anyone could say that. Now, 18 months, 24 months, it could be possibly. I think so, because I think we're going to see continued steady rent growth more in the 4 to 6% range rather than the 8 to 16. And I think we're going to continue to see investors deploy capital into commercial real estate assets, especially industrial and multifamily, as they have been, as a safe haven play. I don't think that's going to slow down anytime soon. And just my conversations with institutional investors, that's what they're all looking at right now.
Mm-hmm.
So they've got capital they've got to deploy, and dry powder they're going to be losing, 8% a year, wherever CPI inflation is.
Yeah.
I want to get to this report real quick, Matt. I just want to touch on the numbers real quick. Top 10 areas with fastest rent growth in Q3 2022. Again, this was in a period where we saw a lot of negative absorption, really. Knoxville, Tennessee, still smoking hot rent growth, 11.7 year over year. Miami, Florida, 10.6%. Charleston, South Carolina, 10.1. Orlando, Florida, 9.4. Greenville, South Carolina, 9.3. Fort Lauderdale, 9.2. So these are all markets that aren't too surprising. Knoxville, maybe a little bit. Maybe people don't think of Knoxville. Then Indianapolis,
in the South.
Yeah, true. Indianapolis comes right after Fort Lauderdale at 8.9. Again, I think I talk to a lot of investors who are investing in the Sun Belt for good reason. And when I say we're investing in the Midwest, they're like, oh, we like the Midwest. We like, Indianapolis seems interesting, Columbus, Ohio, but we just have the growth down in the Sun Belt. It's hard to compete. And we're tracking where the growth is. We're buying at these low cap rates because we're going to grow out of it. Well, Indianapolis is a prime example of where you don't need to go to the Sun Belt and pay an incredibly low cap rate to find some really solid growth. And if you looked at the suburbs around any of these markets, but Indianapolis and included, you'll see some really, really strong rent growth, because a lot of the growth is in the suburbs, not in the urban cores. Following Indy, Salt Lake, following Salt Lake, Greensboro, North Carolina, and then Charlotte, North Carolina, coming in all basically tied at 8.9, 8.8, 8.7. So really, really fascinating report. And just that, so there's still some markets that are going strong, but I think we're going to see continued weakness in general. And then just to touch briefly, office is, office has is the one asset class with the most shade being thrown at it, and without a doubt is by far the most uncertain, because people don't know, or people even want to go back to offices, which people are going back to offices. And there's a correlation between, decrease. The housing formation actually decreases as people are starting to go back to office, and rent growth may be declining and home prices are declining with people returning to the office because the emphasis is no longer doing stuff at home, which is interesting. But yeah, office is, I think, still in a little bit of a trouble. It's unknown. And I had a really good conversation, Matt, with an investor last week who he said, I just want to find someone who's just like ready to make a call. Like they are like, I don't necessarily believe this, but I want to find the person who's like, no, office is coming back. I'm going to make a big bet, a big call, because there's going to be a return to office, and I'm just going to buy at a deep, deep, deep discount to everything else. And I'm not, office isn't my like expertise, so I'm not the one to make the call. But it would be interesting to get someone on here who is making that call. More than anything I've heard about is office to multifamily conversions, and saying we've just got too much office space, let's turn them into apartments.
That's not easy. Yeah, I was going to say, it's like, I was thinking about that, and like, you can't, because every bedroom has to have a window, and some of these office plans, there is a big flat space unless you, I don't know, and maybe you core out the middle.
Not every building. It's not easy. I was talking to a guy in Kansas City who's been doing this, and it's got to be the right building. The floor plates have to be like correct, like the as you said, you want to have windows. So you can't have just like, if there's a lot of dead space in the middle of office, the right size of building, mechanicals are all wrong, plumbing, sewer, it's like, got to redo everything. So you get your basis has to be just so stupid cheap. But, I'm sure there's some deals out there that do work. And according to this guy who's been doing it in Kansas City, they've been doing it successfully.
Eyeball. I wonder, I just eyeball a building and be like, all right, I can kind of picture it in there.
Yeah, you probably can to a degree. Once you've done it enough. Industrial net absorption in the last 12 months, 425 million square feet has been absorbed, 11.8% rent growth, really strong. Top 10 areas with the strongest 12-month absorption for industrial. We got Dallas, we got Chicago, Houston, Atlanta, Phoenix, Indianapolis, once again, Columbus, Ohio, Denver, Memphis, and San Antonio, Tennessee. San Antonio, Texas, not Tennessee, Memphis, Tennessee, and San Antonio, Texas. It's like, I'm not familiar with San Antonio, Tennessee. But it goes to show, industrial is just is still experiencing these tailwinds from supply chain disruptions, e-commerce, resetting of supply chains, and onshoring, and it'll be. I think we're still in the relatively early innings for industrial, just because I think e-commerce still makes up less than 15% of all retail sales, and there's some probably room to grow on that front.
With that being said, I don't know what is retail next, because it seems like people haven't given up on retail.
Retail keeps sticking around, and I agree. I think that retail is a great opportunity in many ways. Retail, net absorption in the last 12 months, 87.7 million square feet, 4.4% rent growth. So, the rent growth isn't crazy, but a lot of people, a lot of individuals I know are looking at retail. But retail is like the worst category asset class that's lumped together, because there's so many different types of retail. It's like, what are we talking about? Are we talking about mall? Are we talking about grocery store, anchored strip mall, C-class strip mall in the middle of nowhere? Like, what are you're talking about? Standalone. There's so many different types of retail.
Yeah, they have the types here, and it is like, I'm not really sure what so they have general retail, mall, neighborhood center, other, power center, and strip center. I wonder what power center is.
Yeah. That sounds cool.
But and like there's a stunning array of businesses that can go into a retail location. And so I always thought that retail is particularly interesting because of what it says about the particular community that that it is in.
It's true. Yeah,
Just
you
like
can tell a lot.
multifamily. So it's very nice to see that there is at least some faith in the retail experience. Maybe not in the office experience, but yeah,
it's much more of a tactical play. I don't think you can just be like, I'm going to buy any retail center in this market. It's like it's so much more tactical. What side of the street you are, what tenants you're going to get, what can you attract, and so last but not least, Matt, let's talk about hospitality. There's been a little bit of comeback in hospitality. Occupancy rates in the last 12 months, 61.7%. The average daily rate in the last 12 months, $143 a room. That's a little bit cheaper than I was paying last week. Revenue per available room in the last 12 months, $88 per room. That sounds good. I'm not a hospitality expert, Matt, but it seems like we're doing better than we were back in 2019. I can tell you that.
Yeah. It's interesting to see that sales volume has increased significantly this year compared to last two, more than double what we saw in 2021. So
yeah, well, think about how many
have a lot of faith.
I mean, people just lost complete faith in hotels because obviously during COVID, everyone who was going to stay in a hotel. But now I feel like there's like a resurgence of hotels. In a way from like Airbnb's Vrbo, because there's all this backlash, especially with Airbnb of the hosts being just very, very aggressive and like overburdensome of like all the rules and like sound meters and like
maybe you have read the same article that I had because
all on the Gray Report.
Maybe no, not necessarily. This was more anecdotal, but yeah, hearing all these stories about you having to clean up after yourself, and then you're also charged with a cleaning fee, and I think it is a product of some people. It's not as efficient. I don't know. I think ultimately it's probably going to be more efficient to let's just layer these houses instead of Airbnb houses. Let's just layer them on top of each other, put them in one place where we can have a lot more efficient structure. But I don't know what they call those. But
are you talking about a hotel, Matt?
I think. When
I talk, I mean, again, I know people are making good money with Airbnb short-term rentals, so not knocking it at all. I'm like totally interested in it. I don't do it myself personally. But when I guess when I think about it, it's like, okay, you're building this, like have all these Airbnbs all over the place, and I've got, 4 here and 4 here and 30 in the town, and you've got to pop over town. I'm like, you're managing a scattered site hospitality business. And I think it's so similar to single family versus multifamily, and there's economies of scale.
Yeah.
But I don't see I don't see people making a transition from like Airbnb to hospitality. Maybe I'm wrong, but like, I don't hear a lot of people being like, well, I started Airbnb and now I own 3 hotels. Like they seem like so different, and the model is so different between the two. I think it's because they're so tied into the ecosystems of Airbnb and Vrbo, and but yeah, when you have to, I mean, it all depends on what you're doing, and sometimes certain trips make sense to get a bigger house and can be much more affordable. You can be the place you want to be, the size, and not a bunch of different rooms. But like sometimes, like the hotel, like you got your room service, they're going to make your bed, it's ready to go, they greet with a smile, chocolates on the bed, versus like being yelled at by your host to, I don't know, about something in the middle of the night. That doesn't sound fun.
Yeah. You see it with I won't get into it.
Yeah. All right, Matt, let's so that was a good breakdown of what's going on in the commercial real estate markets, all asset classes. All right, now let's move on over to this markets and Millichat piece, because there's always this conversation about, all right, real estate versus the stock market. Is multifamily going to do better than the stock market over time? Some years yes, some years no. Historically, depending on how far you look back, is the case that typically real estate does outperform real estate, obviously depending on what you're investing in, where not factoring in kind of tax advantages. But Marcus Millichap put a video together. John Chang, our buddy over there, really comparing the two between the stock market and commercial real estate, specifically multifamily. And Matt, if you don't mind, I'm going to just like zoom forward here, looking to some of these graphs that they highlight. And so this is obviously the stock market, has been way up since COVID. Now it's down about, 24% for this year. But now, looking at the S&P 500 for 2021, again, it was up about 27%. Industrial was up about 18%. These are value increases. Self-storage was up pretty well at 13.6%. Apartments 8.1%. And then office 6.8%, hotel 4.1%, and retail 2.8%. So lagging behind. But the stock market so far this year is taking a dump, down 24%. Not exactly what everyone would like to see. But industrial has done quite well. Up 13% so far this year in 2022. One caveat, and John Chang will mention this, but the one caveat is that this is for the first 6 months of 2022. And he makes the point that we've made that over time is that it typically takes 90 days between a price gets agreed upon, goes under contract, and you close. So these deals that are closing in Q2 of 22 are likely put on contract early in the year. And if there were price declines, and I think that there have been, because we've seen cap rate expansion, that would not be taken into this. So a lot of these prices reflect kind of pre-Jackson Hole Fed speech decisions. But looking at the halfway through the year, apartments are up 10.3%, office is up 3.8%, but see, hotel is really bounced back in a big way, up 13.7%, and retail up just a little bit more as well. So, I mean, if we look at it historically, or so last 2 years, real estate, you're just not seeing the volatility that you're seeing in the stock market as a whole. So,
yeah, you can. The stock market almost wiped out all of the gains it made, all but 3%.
Yeah.
And the combined growth in the apartment market was significant. Didn't wipe off, was really accretive, and so you're seeing a lot of that in all of it. Not only are our commercial real estate assets, they're giving better returns, and I think this is something that he mentions later in the video. It is less volatile, much less volatile, than the stock market, and I think that may be part of why investors come to the stock market during times of volatility, and it increases the value and a little bit increases the competition. But you see steady growth, and very rarely do you see values go down. The only time in the last 20 years was during the Great Recession, when that really hit everyone equally hard. And now the huge dip in the pandemic that we saw in the S&P 500 is in no way mirrored by the commercial real estate market. It just went up and up and up after that.
Yeah. So this is looking over a longer term period from 2000 through 2022. And Matt, you just said it's just much less volatile and just much more of it's just a much more stable investment compared to public markets.
Yeah, that was the line graph I was thinking of when I was thinking of it's a little bit of like, there are probably periods, if you slice this graph and kind of re-zero it, comparing commercial real estate and S&P 500, in which, the stock market raises faster than than commercial real estate.
Oh yeah, 100%.
If you are starting at the year 2000, which is a nice round number, why not start there? Yeah. Commercial real estate returns were 5.6 million, and the S&P 500 returns were about 3 million. What was that? Yeah, millions of dollars. Sorry. So if you had 1 million, you're going to make 5.6 times your money if you put it in commercial real estate in 2000 versus now. And if you put that same $1 million, you would only have $3 million, maybe a little less than that, if you put in the S&P 500. It's just it is incredibly dramatic how much returns were greater for commercial real estate versus the S&P 500.
And just in general, looking at compound annual growth rate, S&P 500 grew over the last 22 years about a 5.3% compounded rate, where commercial real estate grew at about 7.8. So I think which pretty well explains. While the stock market can be a great tool, there's great liquidity. If you're looking for a higher, more stable return, really commercial real estate is a better place to be, better asset class. All right, let's jump in. Yep. Sorry, Matt, go ahead.
Oh, no. I'm good.
Well, then let's, if you are good, I'm good. I think we should go to this Real Page article because, again, commercial real estate's great. Multifamily is great. Well, over the long term, 100%. That's why we're still buying real estate right now, even when I'm getting ready to show you this negative news and story in the multifamily industry. It's just the reality. U.S. apartment demand plunges in the third quarter as new leasing stalls more than expected. Jay Parsons and Carl Whitaker did a really nice video. You can catch this anywhere you can find the Gray Report. Looking at, again, just some not great news for the multifamily industry. This is what we were talking about earlier. People just are not moving out. They're not looking for a new apartment. And these new move-ins have just slowed significantly. And so we've got actually 2 quarters in a row, the slowest amount of absorption in 30 years that RealPage has been tracking this.
This article really stood out to me more than anyone this week because I think it runs parallel to the sentiment of a lot of investors. And after more than another week of interest rate and inflation speculations and worries, really, it's important to address the state of the multifamily market and the implications of our current environment. It's like what might happen next and what the most prudent decisions that investors can make. And if you ignore the kind of moderating force of the apartment market, then you can, you want to have a clear eye about everything. I still think, and I think we framed this correctly, that that apartment assets are a great alternative, consider in a volatile economy like this, but it's not like that we have conditions similar to 2021. And in some ways, the more muted performance of the apartment market in this time is a little bit, it allows for investment without this hysterical speculation that we had in 2021. So that's a silver lining in itself.
No, the silver lining, it should not be understated, Matt. I mean, all this sort of negativity is exciting from a buying perspective, because I think there's going to be incredible opportunities, as there's going to be this lag between people who have just gone to the sidelines, and as conditions continue to improve, and whether rates it's really cap rates normalize and we're already seeing that. We're already seeing cap rates normalize. I'm seeing deals coming out in the 5 caps, and even in the high 5 caps, even up to a 6 cap on acquisition. So the cap rates are normalizing, and I think there's going to be owners who are going to have to sell next year because of the way they finance these assets. And I think there's going to be a lot of buyers who are ready to pick them up, but not as many as there were in 2021. So I think it could be some great opportunities.
Yeah, to kind of catch some of the knee-jerk reactions that people might have.
I think so. And again, I think if you just have a very steady, consistent strategy that's adaptive to the market, but you're always in the market, and with a long-term mindset, you're going to avoid a lot of the pitfalls and making just some quick and rash decisions, whether that's getting in or getting out quickly. It's we're slow and steady wins the race. And I think that's going to be beneficial to those who kind of have that mentality. But without a doubt, I mean, we've seen rent growth decline earlier than expected. Sorry, go ahead, Matt.
Yeah, no, and I do want to put in some caveats that maybe they're intended to soften that fact about a reduced occupancy down like a full 1% in what's usually a high demand quarter. So that's that is sobering news. But there are a couple of facts that may at least soften it. So firstly, demand is down, but rents have not dipped down to a commensurate degree. And if you look at the timing of demand and rent growth changes, there's a lot less lag than I expected between a change in occupancy and a change in rent growth. For example, you see very high demand in Q3 of last year, and those months also saw the highest rent growth. In Q4, the demand was lower and the rent growth was lower. I was expecting to see high demand in one quarter and then the following months would see lower rents, but it seems more concurrent than I expected, which is all to say that the negative demand that RealPage has recorded may not be a sign of bad things to come as much as a record of things that are already happened, that are already happening or have happened. So that's my first point. Secondly, as you can see in the line graph in the RealPage article, the current plunge in apartment demand from February to August of 2022 is almost a mirror image of the hyperactive climb in apartment demand from February to August of 2021. And it leaves us at a 4.4% vacancy, such that in absolute terms, and this is a direct quote from the RealPage article, the U.S. apartment market remains on firm footing. So that's a little bit of a, I sounded like Mayor Quimby there for a second. But yes, I think that the U.S. apartment does remain on firm footing because, apart from everything else, 4.4% vacancy is well within the historical trends. So having made my couple of points to pull this subject out of the dark speculation and into the sunshine, it is worth dwelling on the worst case scenarios and the potential risks that could follow. First, Jay Parsons reminds us that he correctly predicted that interest rates would not meaningfully drive up apartment demand. So that runs counter to the some of the speculation that we've read other places. And Jay Parsons is also not convinced that we're seeing less demand because rents are outpacing wages. He's not thinking that rents are too expensive, but he's also not thinking that mortgages are driving people into the apartment market. So he says, if it's not affordability, what is it? Well, soft leasing numbers coupled with weak home sales point to low consumer confidence. It's this idea that we talked about earlier. It's the broader economic environment that is making people uncertain. And he says, when people are uncertain, human nature is to go into wait and see mode. So yeah, they're frozen. They're not moving around. They're not generating that commerce that we said is kind of crucial to growth. And this wait and see attitude is keeping household formation low, which is what you noticed or what you noted earlier. So I think that that's what it is. It is low household formation brought upon by economic anxiety and a wait and see mode. Maybe I'm waiting on the official word to see if we're in a recession, but the worrying about recession, the uncertainty about what the future might hold is having an effect.
We'll hear about it the day after the election, I think.
That's a good hot take. I like that.
I mean,
guess what, everyone?
Oh, actually, things are bad, and it's somebody's fault, not ours.
Yeah, that's good. But yeah, so sorry. I think that this. Oh no, that's fine. That this was a nice realistic reminder of what we're seeing, which is a little bit, like you said earlier, of borrowing or of kind of getting paid back or whatever it is for the absorption that we saw in Q3 of 2021.
Yeah.
That's the best that I can.
We had like the equivalent of like 4 years of rent growth in 1 year, even 5 years in 1 year. So it's like we miss. This is to be expected.
Yeah. There is mention, I think maybe in this article about the prospect of new construction and new supply coming online. I did sound some skepticism, but it may be active in certain places. There may be places where new supply really makes occupancy a little bit more difficult because of the new, more competition.
Even
more choices.
I think Nashville was one of the few markets that had like some of the best absorption numbers, but so much supply came online that it kind of like squashed it. So.
Yeah, and that's what when you're talking about these speculations on like a national level about supply, that's when you really need to turn back to see what's happening in your own neck of the woods and where you're considering investing, because it's going to be different everywhere, and it's super easy for a highly a huge metropolitan area to increase that supply, and then no one's going to notice that a place like Columbus, Ohio, didn't get a lot of supply because they're thinking, oh man, well no, that's all because Dallas Fort Worth added 1.5 million units or something.
Exactly. Yeah. No, the national. Yeah, exactly. What good are 100,000 units in New York City when you need them in the Sun Belt?
You can't move apartments yet. Maybe through the metaverse.
Yeah, it's true. Digital apartments, we're just all plugged in the matrix. I guess modular construction, you kind of are, but it's not really. All right, well, Matt, that's going to conclude this edition of the Great Report. We didn't get to all the articles we wanted to today. We spent way too much time kind of digging into going into the weeds on a couple of these reports. I think that's okay, but if you were really interested in listening to this Florida Atlantic University study or this Fortune piece, you're in luck, though. All of this, including show notes, you're going to be able to find on graycapitalllc.com. You're going to find them in the Gray Report. Going to Gray, if you go to graycapitalllc.com /newsletter, you're going to be signed up for the weekly newsletter. Again, it goes out every Thursday. And make sure you're subscribed to the Gray Capital YouTube channel. You're subscribed to getting the podcast. That way you stay up to date all the time. You can watch us on video, listen to us in the car, get your weekly dose of multifamily industry updates. And random commentary from Matt Bosnagel and myself. So leave a comment below. Let us know what you think. Give us a like. Share it with your mother, your father, your cousin who's interested in this as well. Your cousin keeps bugging you about it. You might as well share it now. All good things, though. Let's all make some really smart decisions. Be informed, and we'll catch you next week on the next episode of Great Report.